So putting it all together on M&A valuations, what are sort of the key factors that impact your valuation, and how would I rank them? So we've got growth and profitability, then timing, then scale, and then strategic versus financial. And so just to kind of recap, your growth rate, you gotta be over 20%. It's very difficult for any buyer to take a startup seriously and assign it the kind of startup valuations we've been conditioned to hope for, unless your growth rate is at least 20%. Any lower than that, there are frankly so many public stocks that I could just buy as an investor that have growth rates that exceed this. So why on earth should I look at your small company with all of its risks and with all of its dangers when I can just go buy some stock on the public markets? So your growth rate needs to be greater than 20%. That is crucial. And then really, I would say a target growth rate that makes sense from a sale perspective is 50% plus. That's the real target. That's what really drives premium valuations. Profitability is very much secondary to growth, but profitability enables you to control your own destiny, which is very important to being able to say no to bad deals and to being able to wait for better timing, if the timing isn't great. Which brings us to that next variable, timing. The difference from the best to worst markets. So let's just say it this way, bottom of crash. So if there's a stock market crash, then that could be as much as minus 90% from the top valuation, which sounds insane. But if you had been trying to sell your startup in March of 2009, then you would know exactly what I'm talking about. The valuations can be savagely depressed by crashes. And so if you have the profitability, you can wait that out. If you don't, you might have to take a horrible deal, which is the way, frankly, that folks like Warren Buffett make their money, by buying when stuff is cheap. And so you don't want to be the guy holding the bag because you had to sell and you weren't able to control your timing. So timing matters a lot, up to 10x if you're thinking about it from the very possible, like the lowest bottoms to the tops. It could be a huge. Scale matters a ton as well. Scale and timing are almost similar actually in their impact, because if you have to sell early, this can take you from 1x ARR to 10x ARR. Would be the variation, from a sub 1 million to 10 million plus. As you slide up that revenue scale, it unlocks possibility. And then finally, strategic versus financial buyers, you can see a 50 to 100% premium over on this side, which is big, but nowhere near like the 10x that some of these other factors can bring to the table. Growth rate, I didn't say what's the factor, how does it impact? Part of that's because the reason I say that growth rate is so important is that if you're below 20%, probably nobody's going to buy you. It just gets really hard if you have really low growth rates to justify buying a startup company. And so putting all of this together, it makes it seem like, oh wow, if we sell at the best possible time and we sell at the best possible scale and it's a strategic deal, that means multiply all these together and you could sell for 100x revenue. Of course not. Actually, what it means is that you've got to check all of these boxes to get to those premium revenue multiples. And if you uncheck all of these boxes, you can't sell the company at all. But basically, for each of these that you don't meet, you fall away from these premium revenue multiples, and you fall from 10x down to 5x because your timing is bad. And then you fall from 5x down to 2x because your growth rate isn't there. And then you fall from 2x down to 1x because no strategic buyer wants you. And so that's kind of how this works. It actually works in reverse from the top to the bottom. Look like, because again, so many founders are fixated on this idea, well, so-and-so sold for 20x revenue, and so-and-so sold for 18, and so-and-so sold for 8 or 9x, and all of these big numbers that we get caught up in, not realizing that those companies had to somehow pass basically every one of these tests. Maybe they were selling in 2021, so they were selling at a historic high, or 2022, historic highs in the market. Maybe their scale was there, and they were doing 20 million in ARR. Maybe their growth rate was 60 or 80% per year, and they got picked up by a strategic buyer. So all of those things come together for those great TechCrunch stories that you hear. And each one that you knock off the list brings you down, brings you down, brings you down. So that's really how it comes together, but this is how I would order it in order of importance.